91.3 WLRN presents Topical Currents. Today's program begins with a quick update on federal income tax preparation. Of course, the filing date is but 2 weeks away. Good afternoon, Joseph Cooper, Bonnie Berman. We'll chat with enrolled agent and accounting firm president Dr. Stephen Weil, a Fort Lauderdale-based firm, RMS Accounting. He'll have information about any changes or peculiarity to this year's filing or last year's taxes, and more. Well, today we talk about everyone's favorite topic, federal income taxes. Yes, it's that time again, of course. If you haven't filed, there's just 2 weeks before the April 15th deadline.
So we'll learn the basics from enrolled agent and accountant, Dr. Stephen Weil. He's a principal with his wife, Teresa, and president of RMS Accounting. Thanks for joining us.
Thank you.
Your busy time of year.
Yes.
Well, it gets busy all year long, but it's a little bit more nuts now.
I had never heard the term enrolled agent before this program. So if you would, before we get into the meat,
Sure.
explain what an enrolled agent is.
We are part of a select group that is enrolled to practice before the Internal Revenue Service. What that means is we went through a very comprehensive exam given by the IRS under the supervision of the Secretary of the Treasury. They then do a background check to make sure that we're moral enough to represent people in front of the U.S. government, and we can represent taxpayers all the way through all the appeals divisions and all of the audit divisions of the IRS, as well as prepare taxes. We are the only true tax professionals where our designation is about tax. There are three groups of people that can represent people in front of the IRS. That would be CPAs, who get their license from the state and may or may not be tax specialists, enrolled agents, and attorneys that are admitted before the bar who may or may not be tax specialists. But
Now,
we go back to the Civil War.
If you're doing my return as an enrolled agent, that doesn't mean that you're working for the IRS.
No, absolutely.
It's not like I'm filing with an agent.
No, it's not like you're filing with a revenue agent, but it does mean that we've met the standards set forth and passed a very detailed tax exam, as well as met the background check. But we work for our clients, not the government.
And it also means, as you explained, that you'll represent your clients should they be audited at no extra charge.
That is correct. In our office, our policy is if we prepare a return for you and the return is audited, we represent you at no additional charge to make sure that the return is represented as prepared. You, of course, have to have the receipts and documents.
So ultimately the taxpayer is always liable, but
the taxpayer is always responsible for their return, regardless of who prepares it. You don't just get to point, and they're certainly responsible for any additional tax. In our case, if we prepare a return and any penalties are assessed, we would always pay the penalties for the taxpayer, assuming that we had been given all the information.
Now, these days, do more people use tax service, or do more of them go online and solo?
There's a lot less people when you look at in total. The people with complex tax problems use a tax professional. A lot of the millennials that are working for a living and maybe have a W-2 and might even have a home with some mortgage interest are turning to their computer can do everything, their iPhone can do everything, and they're turning to the online services or the computer. The good news about that is it is fairly simple. It is very inexpensive, and you can do it 24/7 whenever you want. The bad news about that is that you're not really sure how secure some of those services are with your data, and if they're doing it for free, what are they doing with your data so that they can actually raise money to pay for it? And the other thing that comes along is the iPhone computer, when you get a tax audit notice or when you have a question about what should you do to reduce your taxes in the future, is not going to be much help.
Let me ask you, though, when you say that because it's free, they may do something with the data, you're talking about like data mining? They may sell it?
Well, they may be mining it. They may not be selling your name, or they may be using your name, but they don't stand under the same privacy restrictions that professional preparers, people subject to Circular 230 of the IRS, do. They're a software provider. So read very carefully the disclosures in there. You will be surprised.
You mean
what
the things
find.
you just agree to?
Yeah, the thing everybody checks the box. If you read it, You may be surprised with what they're responsible for, what they're not, and what rights they have.
And of course, it would take you a week to read it.
Yes, and a magnifying glass.
Tell me, what are some of the indicators that someone's trying to steal your identity or information or money by your filing income taxes?
Well, that comes from a lot of places, not only filing income taxes. We have seen identity theft and fraudulent tax returns filed based on information provided to doctors' offices, hospitals, school boards, and it could be a tax preparer that's using your information. So there's a lot of places it can come from. You need to be careful with who you give that information to. And if you go to do an electronic filing and the government says, wait, we already have your return and you know you didn't file it, that's an indication of you have a tax problem. But remember, that's not the only problem you can have in today's world. It could be a fraudulent tax return was filed in your name. It could be a loan application,
that's common
or credit
now.
cards.
Right.
Absolutely. So keeping your information close and not sharing with everybody is more important than ever.
Is it better to file? Is it better to file early to prevent someone from filing underneath you?
It helps to file early so that a fraudulent return isn't filed before you get in. Certainly does help if you think that's a problem, but it's more important to file accurately. So in a lot of cases, early has become more difficult. People with brokerage accounts, they get a brokerage statement that says, here's your interest, your dividends, and then 4 weeks later they get one that says, here's a corrected one.
Yeah.
And then sometimes you get one that says, here's a corrected one.
Right. Let me ask you this. How do we know that if we do go to a professional tax preparer and we don't do it, online ourselves, that they don't use the data or that they have means of protecting it?
Well, you need to ask them about that. What do they do to protect the data? How long have you been in business? How are your people in your office screened? Most people don't ask enough questions. And in many cases, they don't ask the right questions. If you go to somebody you were referred to that somebody's been dealing with for a long time, that may give you some assurances.
Many of these firms take on part-time help at the peak of tax season, so they may not really know the background of some of these.
Well, that is possible, and as I say, that's one of the things you should ask about. We have a policy in our firm that we run a criminal background check on everybody we hire. We run a credit check on everybody we hire to see what their position is.
Make sure that no one has a lot of gambling debts. Or
well,
something.
We don't want them to be in such a position that they would be dealing with people's identity and people's numbers and people's investment account information that they might be desperate for money.
Right.
And so that's one of the things we're looking at, and we keep that up to date on our staff.
I read that one of the complications this year is this gig or sharing economy income, people who are using Airbnb and Uber, that are Uber drivers and stuff. Will you explain that?
Well, if you're using Uber, or if you're an Uber driver, that's self-employment income. So you have income to report, you have auto expenses to report, you have other expenses. You're going to be filing a Schedule C. You're going to be subject to self-employment tax, and a lot of people are not aware of that. If you're renting short-term through Airbnb, that's really not a rental activity. That's a business activity.
If you're renting out your
apartment, your home, whatever.
Right.
And you also need to be aware, if you're doing that, of your sales tax obligations, as well as zoning obligations in your area.
Or if you're an Uber driver, is your car insurance deductible?
Well, typically you could take all of your auto expenses based on the percentage of business use of your car, or you could take the standard mileage rate. So you're going to have to figure it out two ways in many cases. Am I better off with the actual expenses, or am I better off with the standard mileage rate? You don't get all of your car in either case. You get the business use. Also important that you keep a mileage log so that you can show to the IRS how many miles were business, what was personal.
On this Airbnb, you said something about zoning. What if, because I know a lot of people are doing it where they're not supposed to, and it's not zoned for it.
As far as the IRS is concerned, it's still income and it's still taxable. As far as the sales tax people are concerned, it's subject to sales tax. They're short-term rentals. It's subject to the hotel bed tax in most places.
Wow.
So, but then you have to file a tax return. What were your expenses? What percentage of the time was your property used for these activities? What percentage was it available? How much time was it used personally? So it becomes a lot more complex, especially if you're doing this for the first time.
Could you touch on, for low-income filers, to be wary of instant refunds?
Well, one of the things I see as I drive down the street and at other places are, have 2 kids, head of household, we'll file a return and get you $3,000 back. And the answer is what they're advertising is the earned income credit. And very often one of the areas of fraud that's happening is somebody goes in to somebody, tax preparer that's opened up and is here for the 3 months, and they say, gee, I want that $3,000 you had on the sign. And they say, did you earn any money? Well, no, I didn't earn any money. Well, how about if we make up some income? We'll pretend that you were self-employed or you were selling things, and we'll just put enough income on your return to get you that earned income credit. That is fraud, my friends. You can't just make up income. People understand that you can't make up deductions and you can't not report income, but making up income so that you can get credits you wouldn't otherwise be allowed is also a fraud.
We're speaking about taxes with Dr. Stephen Weil.
I'm almost on overload here.
He's an enrolled agent and president of RMS Accounting, a 30-year-old accounting firm based in Fort Lauderdale. A short break. We'll be right back.
Dr. Stephen Weil. He's a principal with his wife, Teresa, and president of RMS Accounting. And we're talking about filing your 2015 tax returns. Stephen Weil, does the Affordable Care Act have any effect on tax preparation?
It's had a tremendous effect. First of all, a lot of people are confused by all those new forms they're getting, the 1095B, 1095A, 1095C, that lists whether or not they had insurance and when they did. And, of course, we have people that thought they were getting refunds that are finding that they're not because of the Affordable Care Act penalty. On the other side of that are people that went to the Affordable Care Act website and applied and put in income and then made more money than they thought they were going to make and are now finding that the credits that they got to reduce their insurance costs, they have to pay back to the government because of the amount they earned. So you got a credit all year long, and now all of a sudden you find yourself having to pay back $3,000 in credits because you earned $100 too much over the limit. And those of us in the tax industry, we get to tell people this cheerful news.
So you think you're doing something good by now getting health insurance, and now you're saying if you make $100 over?
Well, if you make over 400% of the poverty rate, you have to pay back 100% of your credit. So, for example, if I was making 385% and my boss said, here's a $4,000 raise, and that now puts me at 400%, instead of paying back a portion of it, which is limited, I now have to pay back everything I got. I might have to pay back, in effect, more than the end of the year bonus was.
It should just be that extra percentage, wouldn't you think?
Your right to any of the credit phases out entirely at 400% of the federal poverty rate. So it becomes very complex figuring out how much do I have to give anything back? How much do I have to give back? If I didn't have coverage, do I owe a penalty? How much is my penalty? Who's a member of my household? I've got my 2 children, they're a member of my household. Well, now I have to also make sure that I can prove that I had health insurance for them.
When we were talking about the person who, a lower income person who makes $12,000 goes into the tax preparer, what about that $3,000 credit? Tax preparer says, did you make anything? Well, let's say you made this much money, so I can get you back that $3,000 credit. In that case, well, 2 questions. Number one, isn't the tax preparer also liable here?
Well, certainly, and the IRS does go after, if one of the hints for people is that your tax preparer should always be signing your return and putting their PTIN number on it. That is an identification number for the IRS. If they refuse to sign your return, that's a problem. And the tax preparer can be responsible. In fact, you want to stay away from tax preparers that do this because when the IRS gets them in their sights, they don't just look at the tax preparer, they look at all the returns that person has prepared to see whether or not, they were making up they told all the people that they could take this deduction, or they were making up deductions. And if they're making up deductions for you and they're making up deductions for others, chances are you're going to be in the sights of the IRS when they are.
And my second question is, if you make an honest mistake, you're audited. You make an honest mistake versus intentional fraud. Is there any
An audit
difference?
is not the end of the world, and many audits are correspondence only. I forgot to include this dividend from a bank I forgot about or something. And you're going to pay a little bit of interest. You may pay a small penalty, but it's not the end of the world. You know, if you didn't commit fraud and you made a mistake, you took a deduction you shouldn't have taken, you didn't have the records to back something up that you thought you had, or you lost those records between the time of the tax return and the audit, it's not the end of the world. You will have some tax you may owe, you might have a small penalty and some interest, but you're not going off to jail. Don't start shaking because you get a letter. I have so many people that come into my office holding an envelope from the IRS, and they're afraid to death to open the envelope. And you open the envelope and it says, "Hi, we're afraid you had identity theft last year. Here's a PIN number so you can avoid that this year." Or we got your return and it's just taking us a little longer to process it. Although some letters from the IRS are bad news, they're not all bad news, and you can't know that until you actually open the envelope.
Stephen, in your long career, I'm sure you've seen people go to extreme lengths to claim deductions. What are some of the strangest ones you've encountered?
Well, we've had people look at everything from, gee, I have a dog at my place of business and that's my security system, so I want the dog and the vet and everything that goes along with the dog. And if you're not in the dog training business or the dog guard business, probably not going to fly.
Or maybe you own a junkyard.
You own a junkyard, it might if the dog lives at the junkyard. In many cases, what's deductible for one person may not be for another. Years ago, I had a client that was in the salvage business, and their prior accountant had told them they would rent a boat and rent a plane when a large wreck sunk. And their prior accountant told them that, hey, you're renting a plane. That's luxury travel. That's not deductible. You're renting a boat in Belize or wherever these countries were. That's luxury. That's not travel. You can't deduct that. Well, the answer was they were in the salvage business, and when a ship sinks somewhere, you don't get to look around for a flight. And renting a plane to get to someplace in the middle of nowhere and renting a boat to go out and look at a job that you could decide that you might make $4 or $5 million on, or you might decide it's not the job for you and walk away from because you're going to be liable if you take it. That's deductible for him, where if you or I rented a private jet because we decided that we have to do a seminar in California, that would not be deductible for us.
How about if I hire a private jet as a business expense, supposedly, to take 4 of my buddies to the Super Bowl?
Well, unfortunately, that's not deductible. We can only deduct the amount that regular airfare would cost us to take those 4 buddies, and that assumes...
You say that's unfortunate?
That's unfortunate. And that assumes that the 4 buddies are going to have a business relationship to you, and that somewhere along the way you're going to discuss business. And enact
that's
business.
Easy enough.
Yeah.
I know it's only 2 weeks till filing date is, till the deadline, but is there anything you can tell our listeners that they can still do if they haven't filed and take advantage of anything in these
There
last
are
2
things
weeks?
that you can do. We always tell people the best time to look for the tax breaks is before the end of the year, not after. But if you're not in a pension plan and haven't made an IRA contribution, a great way to put away some money for yourself and have the government fund part of it. If you're in a 25% tax bracket, in effect, you're going to be putting in 25% of the government's money. So that's one way to look at it. You can go through your receipts. People overlook stuff all the time. We conduct a tax interview with every client, and there's hundreds of questions on the interview, and I get to people that I've seen for years, and I'll say something like, oh, you're a teacher. Did you have classroom expenses? Because those are an above-the-line deduction. They came back this year. And they'll go, oh, yeah, I buy pens and pencils for the kids, and I buy I buy prizes. Well, $250 of that goes right on the front of your tax return. The rest of it goes on Schedule A, if you can file Schedule A as an itemized deduction. So there are always things that you can look at, and the key is if you're hiring a tax professional and you're just sending in a bunch of paper and they're sending you back a bunch of paper, I put it to you, you're wasting your money. You need to sit down with that person and talk with them, because if you know everything you're supposed to put in the envelope and they know everything about you, then you don't need to get together. But that generally is not the case. Many times I'll sit down with a client and I'll say, what's new? And they'll tell me nothing is new. And then you'll be going through and you say, well, you have another child you're paying daycare on. Oh, yeah, I had a baby this year. Well, you told me nothing was new. Well, the baby came in May, and, so nothing's new anymore. It's May again.
Right. How about if for low-income people, where they can have volunteers who are knowledgeable tax people prepare their taxes for free?
If you're a low-income person and you want to take advantage of one of the VISTA volunteers, they have to go through a class with the IRS. Not a bad way to go.
Both Broward and Miami-Dade have those representatives.
Have VISTA programs where they're certified by theirs. So it's not a bad way to go where you don't have to pay and you're going to get a return. And if you don't have anything else or aren't going to need to talk to somebody in the future, certainly those are viable services, especially for the elderly. All too often we find people asking about getting returns, going to places and somebody charging them to do a return, and you look and they don't need a return. They're below the income filing threshold.
Anything in particular that's different on this year's 1040 from past years?
This year it's what's different that's the same, because we had a bunch of stuff that expired last year that Congress saw fit to put back into the tax code and bring back, but they didn't do it until December. So we were all ready for these things to be gone, and they came back as of December. So you'll see a lot of things that you saw last year that you thought were going to be gone.
What about these seminars you do? Tell us.
Our belief has always been that the more educated people are, the better they can do. We work hard to help our clients accomplish more. So we do a number of seminars at our office. Once a month we do a seminar. Next one is coming up on the 20th of April. And that's surviving an IRS audit, because people always are more scared than they maybe should be of audits. On 5/18, we have a seminar, Money, Your Children, and Your Grandchildren. We have to include the grandchildren because in many cases, the grandparents have more money to put away for the grandchildren than parents do of young children.
What are the laws on gifting right now?
If you gave a gift of $14,000 or more during the year, you need to file a gift tax return. Now, that doesn't mean you have to pay gift tax. It just uses up part of your lifetime credit, which is approximately $5,200,000 and change.
Oh, I'm almost there.
If it's under the $14,000, no gift tax return. A husband and wife can make a joint election to put together a gift of $28,000. And if you paid directly for somebody's tuition or medical care to either the college or the provider, that does not count as a gift.
And last question. How long do we have to keep our records? I keep hearing all different number of years.
Well, it depends on what records. So the answer is if you bought stocks or you have assets, you need to keep the records at least 3 years from the date you file the return on which you sell them. However, other receipts such as tax receipts, those type of things, 3 years from the date you filed the return or paid the tax. Tax returns you should keep forever. And the reason for that is because the statute of limitations on a tax return runs from the date you file the return. And if the IRS comes to you 5 years from now and says, you never filed that 2005 tax return, okay, how do you prove you filed it? Well, there's good news on this front, though. And the good news is you can image all that stuff, put it on a USB drive or a CD, and keep your records that way.
Okay, I just learned how many mistakes we've made. Dr. Stephen Weil is an enrolled agent and president of RMS Accounting, Royal Management Services Accounting. It's a 30-year-old accounting firm based in Fort Lauderdale. Thank you very much for enlightening us.
Thank you.
Thank you.
It's been a pleasure.
Food and dining up next.